What the heck are quarterly tax payments, and how do you know if you're supposed to pay them as a small business owner or self-employed individual? In this video, I'm going to break down who has to pay quarterly estimated taxes, how to pay them, and how to avoid the dreaded penalties. Hi everyone, Jamie Trull here, CPA and financial literacy coach, and my passion is helping you navigate the tricky waters of business finances and taxes. So if you're interested in getting your finances organized fast and saving on taxes, then definitely make sure to subscribe to my channel because I am coming at you with new videos every single week to help you do just that. And make sure and stay until the end of this video where I'm going to be telling you a simple plan of action to get your finances in order for tax time super quick. So jumping into it, first off, let's clarify what quarterly estimated taxes are. Now, typically when we're talking about quarterly estimated taxes, these are installments you're making towards the taxes you're going to owe on your federal tax return. And those taxes generally include income taxes, right? Those are the ones that have the income tax brackets that you're aware of, and also Social Security and Medicare taxes. These are called other things like payroll taxes, or for those of us who are self-employed, they're also called self-employment taxes. So all of that is going to be filed on your 1040 by April 15th of the next year. So estimated taxes are essentially just an installment plan for those taxes if you are a small business owner or self-employed. Remember, if you were taking a paycheck from someone, they're probably already taking out the taxes that are necessary and withholding them from your paycheck before they give it to you. But as a small business owner, you're likely getting all or maybe some of your money that is actually pre-tax, which means that you're the one responsible for essentially withholding from your own paychecks. And that's really what quarterly estimated taxes are. They are you paying in over the year related to money that you're taking out of your business in draws that has not had taxes already withheld on it. Now, your entity type will play in here to some degree. So if you are a sole proprietor, meaning you don't really have an entity type, you never created an LLC or anything like that, maybe you're a freelancer, that would be considered a sole proprietor in most cases. This does apply to you. Or if you're an LLC, whether or not you have elected S Corp, you probably have some estimated taxes to pay. However, it gets a little bit more complicated with S Corps because you're also supposed to be paying a reasonable salary to yourself. So if you're doing that, you're probably withholding at least some of the taxes that are owed. But even as an S Corp, you probably need to be withholding more than what is being taken out of your salary, especially if you're also paying yourself owner's draws or if you have profit above and beyond that salary. Now, if you're curious to know more about S Corp reasonable salary, how to set that, how to determine what it should be, I actually have an entire masterclass on that. Definitely go check that out. It's our Savvy S Corp Owners Getting Your Salary Right Masterclass, and you can go sign up at jamietrull.com/salary. So does that mean that everybody who's one of these entity types has to pay estimated taxes? And the answer is not necessarily. If you're not profitable, then you're probably not going to have any tax on those business earnings because you pay taxes on your profit, right? The amount of money that comes in, the sales you make, the revenue you make, minus those tax deductible expenses equals your profit. That is what you're going to get taxed on, and that is what you need to pay estimated taxes on. So it stands to reason if you are at a loss position, or if you're not profitable, or maybe even just minimally profitable, you may not have to pay estimated taxes. However, if you do expect to have to pay at least $1,000 in federal taxes, then you should be paying estimated taxes throughout the year. Now, the plus side to paying estimated taxes is that you don't have a huge tax bill that all of a sudden you have to come up with the money for at the end of the year. You've already paid in throughout the year, at least most of it, if not all of it. And just like anything else, if you overpay, you're going to get a refund when you file your tax return. If you've underpaid, you're going to have to pay the difference. And if you did not pay estimated taxes or didn't pay enough, there might also be underpayment penalties and interest that is assessed on that amount that you owe. So not only does paying your quarterly taxes help you avoid those penalties, but it's also going to help you manage your cash flow throughout the year. As a quick PS, if you feel like you're always scrambling come tax time, definitely grab our Ultimate Tax Bundle. There's a special YouTube offer right now. We have it linked down below. Now, if you're wondering how much you have to pay, that is the big question, and it can get kind of complicated. I'm actually doing a video next week that's going to go into the nitty-gritty details, so again, make sure you have subscribed. But ultimately, if the goal is to not have those underpayment penalties, then you can look to the safe harbor rules that will tell you how much you need to pay in, and there are a couple different options that you can pick from. So one thing that's really popular to do is to use last year. As long as you pay in 100% of last year's tax liability, meaning the total taxes you had to pay, then you are safe, right? You will not get underpayment penalties. You may still owe, however. That doesn't mean you won't have to owe, because again, if you have more profit, let's say this year, or less deductions somehow, then what you paid last year might not really be all that relevant to this year. But at least you won't get additional fines and penalties for not paying in enough. Now, if you have pretty good line of sight on this year, you could also pay in 90% of this year, and that also will hit safe harbor for you. Now, obviously, going with what last year's tax liability was is a little easier because you can look at your tax return and figure that out. However, going with 90% of this year means you have to have a pretty good line of sight on not only what your profit is, but also your entire tax situation, including any other income you might have, any credits and deductions you might have. And so that one might be a little bit more difficult. And so if you're going to take that route, you might want to kind of guesstimate on the higher side. I know a lot of people would prefer to overpay and then get money back rather than underpay and have to come up with extra money and potentially be subject to fines and penalties. Now, as you get to the end of the year, I always think it's a good idea to sit down with a tax accountant who can look specifically at how much has been paid into taxes, and they can look at what your projected income and all those deductions and credits that you might be eligible for, and they will be able to really estimate out how much is actually going to be due. But early in the year, that can be really tough to do, especially with a business owner that has variable income. So when do you pay these taxes? What are the due dates for these taxes? And let me tell you, I'll be the first to admit they're a little wonky. So your first quarter installment payment would be due on April 15th, and that would cover January through March. Makes sense. Your second quarter, though, is only 2 months. And that's going to cover April and May and be due June 15th, of course. And then your next payment is going to be for the third quarter, which is 3 months again, and due September 15th. And that's going to cover you for June, July, and August. And that means if you're keeping up with the math, the last quarter of the year, which is due January 15th, actually covers 4 months, September, October, November, and December, just to be as confusing as the IRS possibly can be. Now, I'll tell you, when I do this, I kind of ignore the fact that these are wonky, and I just take what I expect to owe over the year and divide it by 4. That's the easiest thing to do rather than trying to figure out 2 months here and 4 months here. For me, that is generally how I handle estimated taxes, and it just means you might be paying in a little bit more on the earlier side. But again, if that gets me out of any potential penalties or interest, I'm okay with it. Now, if that date falls on a weekend or on a holiday, it's going to go to the next business day. So you might get an extra day or 2 if that happens. So how do we avoid late fees? Well, I would put reminders on your calendar at least a few days before that deadline. It can take a few days sometimes, depending on how you're paying those estimated taxes, in order for that to be processed. So I typically like to do it, say, the week before the deadline, just to make sure I'm in good shape. So I set Google alerts that remind me, hey, by the way, you are due to pay these taxes. And it's not my favorite alert to get, but it does help make sure I don't miss those deadlines. Now, how do we pay these taxes? The absolute best way is through the IRS website. It's super easy, it's free, and it's pretty painless. You don't have to send a check or anything like that. So I highly recommend that. And if you want a walkthrough of all the steps to be able to do that, I have that walkthrough in this video right here. So definitely go check that out after you finish this one. Now, real quick bonus tip, make sure to record somewhere where you're not going to lose it how much money you paid it. You're going to need to tell them when you file your taxes how much you paid in estimated taxes. And Believe me when I tell you, it can be a pain to be looking for confirmation emails to try to remember exactly how much you paid and when, because that's something you have to put on your tax return, even though it seems like they should know that information themselves. This is unfortunately one of those lessons I have learned far too many times. Now, if you're an S Corp owner, I have one more quick tip for you to make your life a heck of a lot easier, and it's also something that I have now started to do instead of having to deal with estimated tax deadlines. Now, because I pay myself a salary, since I'm an S Corp, I'm also an employee of my business, and taxes are already taken out of those paychecks, I actually have set it up to withhold extra from those paychecks to cover the draw side of my business as well, meaning the amounts that I am paying taxes on above and beyond my salary. So any additional profit you have in your business, there's going to be income tax. There's not going to be any self-employment tax, thankfully. Yay, one of the benefits of being an S Corp. However, there are still income taxes that you need to pay. So I typically will add on my W-4 in my payroll system to be withholding extra money from each and every paycheck. And at the beginning of each year, I forecast out how much I think I'm going to have to owe in taxes. And that is what I withhold regularly. And if we have a really good year, I might go in and bump that up a bit. If it's not turning out the way I thought it was, maybe I'll go in and lower it. But that's one way to get out of having to remember one more thing and just have those taxes already withheld to cover both the salary that you're paying yourself and also that additional profit or those additional draws. Now, unfortunately, if you're not an S corporation or a corporation at all, then you don't pay yourself a salary through wages. You don't withhold taxes. So you're gonna have to go the long way and do this through estimated quarterly tax payments. Now, you might be thinking, my finances are a mess. I don't even know where to look to figure out how much profit that I have in my business and how much I'm supposed to be paying taxes on. And to you, I would say the very first thing I would do is get organized. Make sure that everything is separated out and you are paying everything through a business bank account or business credit card, and you're not commingling those funds. That's going to let you see what your business income is and what your business expenses are a lot more easily. And if you need more help getting organized and pulling everything together, I have a template that would help you, as well as some tutorials and things like that to make sure you're maximizing your deductions in my Ultimate Tax Bundle linked below. Now, if you don't want to use last year's number and you're still wondering how to come up with an accurate estimate for this year, well, I'm going to be talking about that next week in my video, and definitely make sure to subscribe so that you can see that as soon as it's ready. And if you need further clarification, if you have questions about anything, we have a new monthly YouTube live show where I come at you with news, to-dos, and cues, and those cues are questions that I get from you. So make sure to click the link down below to submit a question for our next YouTube live show, and I'll see you soon.